Well, greetings and salutations. Another Tuesday evening. Can you believe it? I don't know where the days go. It feels like yesterday when I did the last show. But anyway, nice to see everybody on. Hope you're well. I'm in pre-show mode just for a moment or two, just to allow people to find their way in, and so we can start on time. Those, of course, following the dogs will see that the dogs have now climbed back into their basket. So they are actually a bit confused because we had an hour change here. So they were up early, and so they think it's lunchtime now, but it's not really. But they were quite keen to give me a nudge a moment ago, but that's now disappeared. And of course, for those interested, the studio set up, Damien's there ready to come in. We've got everything else running, the chat and the super chat and everything else, and the multi-view and other data as well. So everything is pretty much there. And big show tonight because, of course, we have Trump and tariffs, we have the election, we have the RBA, we have Taiwan being under an exercise from China, and that's just where we start. So I don't know. We live in an interesting world, an interesting time. So we're trying to get into some of those tonight. Anyway, I think everything's there. We've hit the 8 o'clock mark, and so I'm going to start the show formally. I'll be back in just a moment. Well, good evening and welcome to this live stream on the 1st of April, 2025. No joke, 1st of April. Martin North here from Digital Finance Analytics. Nice to see you on for a Tuesday evening again. Thank you for taking some time out. And this is going to be an important conversation today because there is so much going on, particularly with the markets. And Damien, of course, is with me, and I'll bring him in just a second. And just to say that, we'll try and give you a bit of a sense of what's going on, but also some thoughts about how to react to it or how not to react to it, because I think there's a danger in overreacting to all the things that are coming through at the moment. There keeps being a blast of news here and a blast of news there, and Trump's tariffs are here, and then they're going to be, it's all over the place. So trying to make sense of some of that is what we're going to do. And obviously there'll be plenty of time for questions. Before I bring Damien in, let me just remind you that we don't provide specific financial or legal advice. This is a general conversation only. We do invite you to make your views known in the chat. Feel free to add your comments and questions as we go. If you'd like to get a question to me or Damien specifically, if you use @Walk the World, that means it gets into my queue. There's more chance I'm going to see it. I don't necessarily follow everything that's going on in the chat because it's really, really busy. And some of the conversations are on sort of a side note, so I don't necessarily follow all of them. I've also enabled Super Chat, which means that if you want to make a contribution to what we do around here, you can do that, or indeed get your question to the top of the list. And for those who do contribute via Super Chat, we really appreciate it. It really does help. We don't do this for profit. We do this because we think there's a really, really important conversation to be had. And frankly, in the current environment, more so than ever. Right, let me bring Damien straight in and we'll get right down to the nitty gritty. Damien, welcome back.
Hey, going, Martin?
How you going?
Center myself a little bit.
Yeah. Are you having fun yet? Is how I started the earlier conversation with. There's a lot going on. Isn't there? And as an investor who is invested, one of the interesting challenges here is to, as we've said before, separate signal from noise. But it is actually worth reflecting. Things like, for example, gold reaching, this is the gold futures, reaching another all-time high, which tells you something quite important about potentially what some people in the market are thinking in terms of a flight to quality. On the other hand, if you look at the ASX 200, well, that's significantly off its peaks, but slightly higher over the last couple of days. And in fact, if you look around the world, there are some quite interesting and contradictory signals. So, for example, if you look at the German DAX, it was very high, but it's come back and now it's gone up again. So there's a
Well, the DAX, and especially when you look at that, the DAX from wherever that is, I don't know, we've basically had a month of going sideways.
Yes.
Really,
yes,
it's not really. It's been pretty reasonable performance there versus the US, which is much more down.
yeah,
And Australia as well.
And the interesting question, there was a really big discussion going on. Well, maybe now's the time to invest in Europe or maybe Asia. And, some flows of funds have been coming out from the US. We've still got the Trump thing. So, we had the first little inklings with some of the particular minerals. And now, of course, we've got the big day tomorrow, Liberation Day or T-Day or whatever you want to call it. And even now, it's not clear about the nature of the tariffs. And, is it the start of a negotiation? Is it going to be imposed across everybody? I was interested to see that the UK had cuddled up to Trump and had actually offered him a royal visit to Rome, thinking, well, that perhaps will solve the problem, but I'm not sure it's going to. So I guess the sort of the starting point has to be, from an investment perspective, if you are invested, to what extent do you sort of look through this, and to what extent do you actually react? I know you did react earlier on in the over the last month or so. You actually did sell some stuff to be able to position.
Yeah. So that was last time we were on, just talking about how we'd taken a bunch of profits just with the view that, look, things were getting, we were starting to get further down the rabbit hole. Look, I think the main thing I want to start with is sort of trying to avoid. We're definitely going to get back to what's going on in the markets, but I want people to sort of take that extra step back first and go, well, the worst time to sort of try and generate a fire exit plan is when the fire is burning.
Yes.
You want to try and do it beforehand. And if you haven't already got one, well, let's get you one, I think is the main thing. So because you want to know what you're going to do, because markets will go through downturns, and you want to know what you're looking for. Is this just is a fire alarm where it's broken every 20 minutes because somebody's burnt some toast, and so I need to, might not take that as seriously, or is this a serious, I can see the thing on fire, and I need to know what's going on. So I think that the thing I want to start with, though, is what are you trying to do with your investments? Now, some people are trying to trend follow and trade on a short-term basis. So if you're basically saying, yeah, look, I'm going to buy when things are going up, and then I'm going to sell when things are going to go down, I'm going to run with the herd, I'm basically going to hope that I can stay in front and I don't get trampled, when it reverses direction. And so that's often momentum traders or day traders or whatever, and you don't necessarily have to be a day trader. You might just have like this view that, like, I'm just buying when market's going up, and I'm selling when they're going down. Now that's a different story to somebody who's taking a longer term view, and their plan is to sort of lean in and lean out of the cycles. Because what you want to make sure you're doing, if you're taking this longer term view about leaning in and leaning out of cycles, where you're saying, okay, I've picked my level that's right for me. Call it 85%. That's sort of what we set it as a growth fund, which is lots of stocks and a little bit of cash and bonds. And the idea is that as you get to the as markets sort of head up and you sort of reaching peaks and getting concerned, you get a little bit more cash and bonds, and you sell down some of your stocks. And then when markets take a fall, then you start looking to switch back the other way. And you're really just trying to manage the cycle. You're not trying to go 0 to 100. You're not trying to say, yes, I think I can pick exactly the top, and then I'm going to try and get in at exactly the bottom and try and pick those ones. So yes, that's the first thing. Try to work out what are you genuinely trying to do, and then don't change your mind in the middle of it. Like if you're sitting there with a plan to sort of lean in and lean out of cycles, and then all of a sudden feel like you have to go to 0 because you're worried about things falling over, or you have to go to 100 because all of a sudden you're much more you're much more comfortable with it, then that's when you're going to start running into trouble. The other thing is keeping in mind when you're doing this, problems with taxes. So there's a lot of stocks that are up a lot in the last couple of years, and so you might have something. Take NVIDIA, for example, still up well over 100%, depending upon when you bought it might be 200 or 300%. And so if you sell that today and you're sitting on a 200% gain, then you bought it for $100. It's now worth $300. If you sell it, you're getting a tax bill from it. You've got that, that's a guarantee. So, and if you're on the top tax rate, and depending upon timing of when you bought it and everything like that, you might be paying 47 You're probably, the best, you're probably paying 20 or 30% on it. That's a guaranteed 20% you're going to pay on that. Even if you've got these capital gains and everything like that, you're guaranteeing it. You know how much you're paying on it. The market's falling another 25% isn't guaranteed, but you selling and realizing that capital gains, that's guaranteed. And then people go, well, yeah, but I'll just sell the stocks that are down, or I'll keep the ones that are up. And you're like, well, just a minute. So now you're going to end up with a portfolio that's chock-a-block full of the 10 stocks that you were overweight, and now you're wildly overweight these stocks, and you've got rid of all the ones that might be down because they weren't the stocks that performed well in booms, but they might be the stocks that perform well in busts. And so there's this whole tax angle around just saying, look, and trading fees and all that type of stuff like that. There's a surefire way to reduce your investments is rack up lots of trading fees and rack up lots of tax bills within it. So trying to manage those two parts, tax part, and then the other part about that trend and leading into cycles. Another one which I find a lot of people get caught up on is feeling as if they've got to do something. They've got to actually get out, and so whereas you pick this level and say, okay, well, look, whatever it is, I'm at 85% normally. I've pulled back, we're at 70% or 65% or whatever the right level, and that's the level you think you should be at, or your bottom case, and then you switch back in. But then markets are going down, and you feel as if, I've got to do something else. I've already sold to the right level, but I feel like I've got to get out and do something. But no. Pick your levels, and it's the same on the way up. If you've said you're going to have 85% stocks, and markets are booming, and now you've got 90 because they've carried you higher, that's the time you got to sell back down again and use that discipline around that. And it's the hardest discipline because it's the opposite to what you feel like you should be doing. And so same on the way down. If you've said, okay, 65% is the level, and then markets fall 10%, and now I only own 59% stocks. Well, if I've said 65% is my bottom level, I'm going to go out and buy some more, switch to more cash and bonds, and it might feel bad, but that's the type of, they're the types of trades that you need to do to over the longer term to make, ensures that you are buying low and selling high over that. And the other thing to think about is that, when you are getting out, there's two decisions you've got to make. So you got to make, there's a decision to get out, but you also need a decision to get back in again at some point. And the best thing I can offer to people is to have that ready to go before as you're getting out of it, you need to have written down what is going to prompt you to get back in, because it should be a factor of time, price, and fundamentals. If you're saying, look, I'm getting out because I think it's going to be chaos and world market's going to be terrible and whatever, you've got all your reasons, and you've got to sort of pick some time frame and say, well, if I'm sitting here in 2 years' time and markets have sort of gone up and down and sideways, they haven't really gone anywhere, and it's 2 years down the track, well, I've got to acknowledge that whatever disaster I thought was going to occur didn't occur. Maybe I should have that plan to be starting to move back into the markets, because if it's an imminent disaster you're forecasting, is sort of don't hold on forever. Or there's a part about, look, if markets fall to certain levels, this is where I'll start getting back in again, and if they fall further, I'll get back in even more. And then so there's that part, and then the last part is the fundamentals. How bad am I expecting things to get? And then and what are the prompts to show that it might be turning around? So I've used, as I think I spoke about last time, there's effectively two puts that are sitting out there that I'm watching as sort of a prompt to get back in again. One is a Fed put, in terms of when the Fed steps in and says, hey, growth's really bad, we're going to be cutting rates, we're going to be throwing money at the problem and getting back in. That's a while away. That's, we're very early stages. We don't even know what these tariffs are going to be. We really haven't seen much of a growth slowdown at all yet. That's a put which may well come at some point, but it's going to be a while away. The other one is your Trump put, which is, he's got a Treasury Secretary who's basically advocating a J curve, in terms of saying, let's take some pain up front, and market's going to go down, growth's going to go down, but we've got this other side where we're going to rise on the other side of that J afterwards. Now, taking some short-term pain for longer-term gain. There's as long as your plan is solid and all that type of stuff like that, there's some good reason to sort of buy into that. My thought on Trump is that he hasn't been the best at patience and long-term plans, and so short-term pain, he could decide that actually, you know what, I'm sick of short-term pain. I'm going to go back to tax cuts and throwing money at companies and deregulation and let's get this economy booming, because people love me more when things are booming rather than a bust. And so at some point he will flip and throw more money at this problem. The question is that 18 months time or is it 18 minutes time? Nobody knows, least of all Trump. And so having those sort of fundamental targets about saying, okay, well, look, these are the things which we're watching for, regardless of how bad I think things could possibly get. I need to take into account that things change as well. And so, so that's my sort of big picture ones. I don't know if there's any of those I should be digging into more detail or.
Well, I just want to make a couple of points, because I think you've outlined very, very powerfully the sort of the way to think about the problem. But for individual investors, they need to think also where they are on their journey of investing. What I mean by that is if you know that you really are not going to need access to your savings in the short term, then you have one view. But if you, for example, are thinking of retiring in the next 1 or 2 years, and you'll be relying on your investment portfolio at that stage, your whole lens through which you look at this event would be quite different, it seems to me.
Yes.
So you need to not just take the generic view, but you need to think about where am I on my journey, which is back to what do I need my portfolio to be doing for me now, and also ahead. Am I looking for it to ultimately start generating income for me, for example? Or do I need to actually become more conservative because I can't afford to lose the capital that I've got? Those sorts of questions seem to me to be a very important part of the story here. And the final observation, and again, what I quite often see, is that people who are perhaps less experienced in investing, when things start to fall, that precipitates them often to selling because they think it's better to sell before things fall more. And quite often that is actually a mistake.
Yeah, so markets are forward-looking, and I think what people confuse is they confuse prices with fundamentals. So it does make sense when the economy is good and getting better to be buying stocks. It does make sense when the economy is bad or getting worse to be thinking about selling stocks. That makes sense. But what you need to keep in mind is the markets are usually in front of you in terms of when markets are falling, it's because they're pricing in things that haven't really even happened yet. And so when you're seeing that and you're seeing the worst of it, that's quite often when markets are starting to say, hey, we're getting close to the worst of it. Now's the time to be starting to get back in again, because there's only upside from here. And that's where if you're only sort of focused purely on what prices are doing, you can get the two confused.
Yeah, absolutely. And I think that remember that the professional investors will often be one step ahead of everybody else pretty much all of the time. And, as we've said before, and I want to just underscore it again, because I think it's now more critical than ever. If you listen to the talking heads and they're giving advice about what people should do, remember that they've already pre-positioned, right? So
yeah, that's
it's
right.
not
everyone's talking their own book.
Yeah,
yes.
It's not a level playing field. Now,
last time I came on here, Martin, case in point, I didn't come on and say, hey, guys, I'm just about to sell. Can you please sell before me so that I can then, take advantage of lower prices to sell out my stuff? It was like, no. That's what I've already done.
Yeah.
Yes.
Yeah.
And actually, just on your point as well, especially for people who might be in superannuation and anyone younger people, I think there's every now and again I run into people who are very worried about the whole situation. And then I'm like, just a minute, you've only got whatever, 100,000 invested, and you're putting away as much as you possibly can. It might be 25 or 30,000 a year. The price, yes, the 100,000 is important, but you've got another 10 years of putting away, and you're going to be putting away $300,000, $400,000, $500,000 over the next 10, 15 years. Stressing about the 100,000 and the right weights to that is less important than making sure you've got the right allocation for the next 10, 15 years. And as you're investing all this new money, that's being invested in the right assets as you go along as well. So, yes.
Yeah. And plus be conscious of the fees that you're paying along the way, because, actually fees draining value out of your portfolio over that duration could potentially destroy a whole lot more value than a misallocation.
Being clever with the timing for this week or next week or in 3 months' time. Yeah, absolutely.
Now, just on the tariffs, Cookie sent this chart across, which is actually quite brilliant, because I said I wanted to take account of the fact that if you go back to the 1930s, you can see there that there was a considerable hike up in reciprocal tariffs. It was usually higher back in 1901, but the worst case scenario could be up to 35%, which is higher than it was then. Now, that's a very significant and, frankly, disturbing chart and a disturbing perspective. Now, we're not saying that's going to be, because nobody knows. As you say, Damien, we don't know whether he's serious or not and how serious he's going to be. But there are consequences if these tariffs become reciprocal, and it changes the game in terms of global trade. It changes the game, therefore, in the potential investment returns that companies are going to get from their trading, and that translates into their share price and what their share price could be. So there is also a significant level of uncertainty in all of this.
Yeah, that's right. And so I spoke a little bit last time about this whole idea of, if you've got a company who's sitting in the US thinking about investing, and they're like, well, if I build my factory in Mexico, it's 20% cheaper. But maybe Mexico is going to have 25% tariffs, and so therefore I should build it in the US. But then you're like, well, just a minute. If I build it in the US, though, and then the tariffs are zero, all of a sudden I've just built a factory that's 20% more expensive than all my competitors who build in Mexico. So I'm just not going to do anything. And I think that's where I think the danger is, in terms of because there hasn't been a consistent narrative. I think if Trump had come out and said, you know what, I'm going to put effectively 20% tariffs on everyone, and this is what they're going to be for, and this is how you're going to avoid, countries that do this are going to avoid it, and countries that do that are going to get big higher tariffs, and there's this whole sort of theme and a strategy and a thought process behind it, then I think companies would then go, okay, I understand what he's doing, why he's doing it, and how things will change. And so therefore I can now feel comfortable enough to go and build my factory in Mexico or in the US or Canada or whatever it is, knowing that this is what the regime I'm under. But because it seems haphazard and scattered, and maybe somebody will get one, maybe they won't, maybe this is a tariff because, I didn't like the way fentanyl was coming through your borders and whatever it is, like those types of things where people can't really understand, well, there just doesn't seem to be much fentanyl coming through Canada. What do they do to avoid the tariff? Who knows? And so, I think that's where that uncertainty comes about. And I actually did a bit of a run through last week to say in my last podcast, just saying, okay, let's go and look at what's actually going on in as up to date as we can in terms of the data that's out there, because we've seen some pretty big falls in consumer confidence and pretty big falls in business confidence. Now, there's sort of three levels of data, and I'm sure you speak through this with you on the podcast before. Is that you've got your sort of forward-looking data, which is timely, and it's about asking people, what do you think you're going to do, and are you going to spend this money, and what do you see prices doing next quarter, and all these types of forward-looking indicators. Then you've got your coincident indicators about what is happening right now, but they still tend to be surveys. They're not sort of the hard data. And then finally, you sort of get the hard data coming through later in terms of, okay, what did you actually have as profits, and what did you actually report as earnings? And that's not going to come through for a while. And so each of those bits of data can be more and less reliable. And so the real thing that's going on at the moment is everyone's just digging straight into all the forward-looking stuff and trying to say, what is really happening. So there's lots of chaos, but look, if sort of Joe Sixpack in America is like, well, there seems to be a lot of stuff going on in the news, but I don't know what it's all about, I'm just going to keep doing what I'm doing, then maybe there's going to be less effect than if he's sort of sitting there going, well, my sister just lost her job in working for the government, and my brother-in-law, he's worried about losing his local government job because all government jobs are evil now, and I'm concerned about this, and so I'm not going to spend as much money. Then we've got sort of bigger concerns. Now, consumer confidence stuff has definitely fallen. I don't know. I could go through a few charts, but I think I'll probably leave that actually as said, because I think we've got a lot to talk about this time around. If you look at things like the manufacturing purchasing manager indexes, they are all falling and sort of looking at sort of negative type, below 50 in terms of saying, okay, they're looking like going into downturn. The services though actually had a bit of a jump back. Like they fell back in the prior month, and then this month they actually all spiked upwards. And so there's, that sort of, it makes sense, I guess, in terms of the manufacturers are like, okay, we've got tariffs coming, things will be worse. But the services is actually sort of surprisingly strong. And then you start jumping into companies. And the interesting thing when I was looking at companies is I've gone back to companies that have just reported in the last sort of week or so. Last 2 weeks. And you've actually got a reasonable sort of basis in this. And the companies then will have a conference call. And at the conference call, invariably, one of the first questions that's asked is, what's going on right now? And what are the tariffs doing? And what is all the uncertainty doing? Now, I've got a list of 6 or 7 different US companies here. There's Carnival Corp, which runs cruises. So that's sort of a relatively big ticket holiday item for people. Darden Restaurants, which is sort of like a sort of mid-tier sort of restaurant for, sorry, let me put that a bit bigger. Some sort of mid-tier restaurants, a bit like, I guess, Sizzlers type things for people in Australia. Dollar Tree, which is sort of like the reject shop type thing. Centers Corp, which is does uniforms and a whole bunch of services for corporates. Paychecks, which sort of basically manages payment software for companies that have got to manage across all these different states, and all these different states in the US all have different regulations, and so they manage that. And then Lululemon, which is activewear mainly for women, sort of upmarket. But Carnival Corp, big upgrades, everything's looking great. Darden Restaurants, no changes, solid result. Really just sort of going, well, we can't really see what's happening at our end. Dollar Tree is pretty strong. They're actually expecting margins to improve despite tariffs. So they're basically talking about how they've done all this work to source stuff elsewhere. And, reading between the lines is effectively saying, well, there's going to be tariffs around, and so our competitors are going to have to raise their prices by whatever 5%. But we think we've managed to get around the tariffs, and so we'll be able to raise our prices by the same 5% and improve our margins because our costs won't go up by that. Having said that as well, I think sometimes you do see some trading down when things get concerning. Like people start going, well, I used to shop at whatever, pick your name. I used to shop at Myers, and maybe I've moved down to Kmart, or I used to shop at Kmart and I've moved down to the reject shop, or whatever it is. There is some trading down that you sometimes see, which some of the lower, the discount shops can sometimes give you the wrong impressions. Centers Corp, talking about other corporates, they're really talking about strong growth. They're not talking about any changes in their customers. Paychecks actually had a bunch of comments. I think I've got them on here. Looking about double-digit growth and hiring activities. Actually, I won't go through it all, but hiring activities all looks really, really strong. Lululemon put up their comment. They sort of you could read that as half empty, but most of the rest of the comments they had was really half full. So I guess it's only a handful of companies, but these are all the large ones that have come out reporting numbers in the last couple of weeks. And they're really not seeing anything hitting at the moment. So, not to say things won't get worse. I do think things are going to get worse, but we're really at the moment in this. We've got this uncertainty about what expectations are from these tariffs, but we've already seen that very little has happened to the US psyche yet. And then when you dig into some of those. When you dig into the surveys, the consumer confidence type surveys, it's all about outlook as well. So if you look at them and say, well, what's the how are things right now? They say actually things are fine. They're pretty good from a present situations. This is a I can't remember which one this one is. The conference board. Yeah, they're sort of like the top line is how are things right now, and then the expectations is how things going to be. And it looks pretty dire in terms of it's been a pretty big fall, but it's pretty similar levels to it been a few times over the last couple of years. So it's not terrible yet. So so I guess where I'm getting to is, look, I still do think we're going to see some relatively significant downturn that could well lead into a recession, but we're really not seeing any signs of that just yet. This is you need to acknowledge that and say, well, things could change, and maybe a lot of the American population just ignore the noise and just get on with living their life and keep spending money. And so maybe it's just a bit of a growth slowdown, and maybe that's a good thing, and it allows the Fed to keep cutting rates, and maybe that's a great investment environment, and things slow down a little bit, and then Trump starts throwing money and tax cuts and everything at these companies, and all the regulatory changes come through, and earnings growth comes, and off they go. We really haven't seen anything in the way of earnings falling. Pulled out the latest numbers from today. And look, they're certainly edging down, but they always edge down. You need a bit of a microscope to see the differences. So, Q1 numbers, well, that's just, companies still reporting their numbers. Q2 numbers have basically fallen from 9.5% growth to 8.5% growth. So, so it's not good, but that's pretty typical. Like you get lots of periods. So, that chart we've got there, just over that chart there, they've fallen from 14, 15% growth back to 9.5% growth. Analysts are often just way too optimistic before the numbers, and then they gradually just work their numbers down. And Q3 and Q4 numbers, they're edging down, but you need to you sort of need a magnifying glass to make sure you're seeing what the changes are, and there's certainly nothing that you would be concerned about in an ordinary situation. In a more positive, if we didn't have all this noise going on and you saw that same graph, you certainly wouldn't be running for the hills. So so this is we're in a very difficult position right now. We think we know what's coming. We can't see any signs of it, or any concrete signs that are showing you that this is what's happening. And so if we start seeing those concrete signs, we'll sell out more. Markets will as well. We'll have another leg down, but maybe, as I said, people just ignore it. It's just it's important for newspapers and the finance community, but just not important for the average consumer.
Well, I think it's very interesting that if you look at forward expectations of where the markets will be, at the end of this year, there's a huge wide range. So some people are calling another leg down plus, and others are saying, no, this is mostly noise. It'll shake through. Later in the year, things will get a little bit easier. We'll probably get more cuts from the Fed to help, and essentially, no, don't panic. So it's fascinating that no one really quite knows. Now, in Australia, just on the consumer confidence front, it's quite interesting. So just on this, if I go there, you can see here that Roy Morgan published, this is the ANZ Roy Morgan consumer confidence, this just today. And they're basically saying that confidence increased. It's a strong increase in households' confidence in their current finances after consequential falls. And they're saying on a 4-week moving average, renter confidence continues to trend up, while outright homeowner and mortgage holder confidence is down, and outright homeowner confidence has fallen sharply through 2025 so far. Now, just to be clear, if you look at the average, the longer-term average, we're still way below, right? So, confidence is up. Well, it's up from a low base. So you've got to understand where confidence is from as well as where it's going to. And then the other one that came out was retail turnover. And they basically said, well, retail turnover was up, but actually 0.2% month on month is pretty low. and that's 3.6% compared to last year. And if you, of course, bear in mind that this isn't inflation adjusted, so once you put inflation in there, which is probably for retail above the 3.6% in real terms, many households are spending less. So once again,
and then also, Martin, population growth as well.
Yes, good.
So
you took the words out of my mouth, absolutely, because I was going to say, and of course the other factor in there is population growth. And the final chart I just want to bring into this, because I think it's quite important, is this one. This is actually from the government, and it shows you the share of the tax take that is actually from personal income tax. And you can see there, this is actually from a year or so ago, but it's showing you that their expectation is it's rising, it's higher than it has been, and it will continue to rise. So that's the other factor in all of this. Not only you should be thinking about the consumer and what they're thinking of spending, but think of their capacity to spend, because, despite the election that we're now running into and all the promises and, we'll give you a little bit of a cup of coffee in a year's time in your tax or whatever it is, or we'll give you a discounts on the on the petrol that you're going to be buying. The truth is that a lot of households are being squeezed by this perpetual increase in the tax take, which actually is a more significant impost on many households than the interest rate charges. So it gives you a bit of a broader perspective. So my argument is, again, we're not seeing a huge amount of negatively spinning through even into the local stock market yet, right? There's some uncertainty, but it's a bit the same. The indicators are, all over the shop, really.
Yeah, and look, Australia, if you're going to pick a country globally, if there's a bit of a tariff war outbreak and Australia is not involved in putting up barriers and between ourselves and China and ourselves and Europe and ourselves and the UK and places like that, then we're probably actually, looking at cheaper goods largely. So, and we made a decision in the 2000s to basically to get rid of our car industry, and that is we won't really litigate issues with that, and maybe there's some military stuff like that. It's often quite good to have car industries if you want to sort of be able to flip to a more militaristic economy at some point. So, but we've made the decision to get rid of it. So the question now, in terms of if there's global car tariffs and everyone's trying to stick tariffs up, there's no reason for Australia to have car tariffs. We're not trying to protect any local industries. Makes more sense for us to say, well, we'll take your cheap cars then. If you want to get rid of, and we might find that there's just a lot of products that China's basically going, well, I wanted to sell this to the US, but now it's going to, it's now 30% more expensive to sell it to the US. So I'll just dump it on whatever markets I can get. And Australia won't be big enough to take it all up, but it'll certainly take a portion of it. And we're sort of factoring into our models that that we'll probably see some reasonable deflation in goods for Australia, whether it's Europe or China or wherever, Japan, South Korea, trying to get rid of goods that they would have otherwise sold to the US. Now, is that a great thing for Australia? Well, the question is, we've already decimated our manufacturing sector. Do we want to further decimate it, or maybe it's some, I don't think either party's talking about trying to protect our manufacturing sector, though. I think that's been. That horse has long since bolted.
Yes. We might touch on manufacturing and the discussion about gas a bit later on in the show. Before I get there, we should just record the fact that, of course, rejoice, home prices are up again, according to the CoreLogic index. Never mind anything else, home prices are up, so that's good, isn't it? A record $820,000 on average. If you look carefully, you'll see that not all markets, Hobart's down a little bit, but I find it quite fascinating that the media went to town on this. If you look at it in more detail, actually, it's not quite as significant a move as it was perhaps reported at, and you can see there that we're still off peak, particularly Melbourne, of course, whereas Brisbane and Adelaide remain at peak. So that's quite interesting. And by the way, if you look at the regionals versus the capitals, regionals have actually been outperforming. So all up, there's some move. Now, I don't believe that these statistics show the granularity, because the truth is, of course, that different markets are behaving quite differently. But it is interesting how the media goes to home on it. The other point here is on the rents. This is another important. Rents are still rising, and remember, these are advertised rents. These are not rents that are actually increased for those people already in rental accommodation. And they're saying it's rising again. And in fact, my own surveys would suggest that for those people who are in current rental accommodation, they are still being confronted with rent increases, in some cases more than 10%. So the rental sector is still a problem. And even on this publicly available chart from CoreLogic, they're saying, this is a national high. So I think this is an important context for this as well, because, of course, everybody's worrying about property and what's going on with the property market, and this is a signal. But I was amazed how positive the media reported it.
Yeah, that's right. And I can't remember who. I just saw one in the last week or two with someone had written one was it's circulated several times, this type of theme, but it's this idea that saying, well, in terms of Australia, if we've got very high assets. The assets for Australians are very high. But if you just sort of took the view that, hey, everyone just doubled our house prices, then have we really got any richer? We're still living in the same houses. We've still got the same, all it's done is cost new people getting into the market more and drain on businesses and all these other bits and pieces. That it's not houses aren't something you can sell overseas. Yes. And so
they tend to be rooted to the spot rather, don't they?
Exactly. And so, the whole idea of just, all our house prices getting more expensive does not make us wealthier as a nation. No. But in terms of, if you want to have a bull case for housing market, though, is we do get this big wave of deflation coming through from goods. We get very weak growth in Australia because we've got biggest trading partner, China, is hit by tariffs. Plus, they're still going through this massive housing market, that's showing no sign of finishing in China. Is that the housing market keeps falling, and the more important, the construction keeps falling, and so that's one of our biggest exports out there. And so you sort of look at those and you go, okay, Australia ends up in this scenario where interest rates probably can be falling if we keep up the level of immigration. To try and offset so that we don't go into a recession technically, to sort of keep that going, is that maybe we're just jamming more people in. We're lowering house prices. Lowering interest rates and forcing house prices up by increasing demand, and we haven't got the supply because our building companies are all falling over partly because costs are on the way up because of the energy costs, and which is a big part of building a lot of these your tiles and all other things. We're sort of in this situation where you can see a case over the next 2 or 3 years where house prices just go higher because all the other factors, and that's the only way we can use to to distribute a scarce asset that we haven't built enough of, and we're jamming too much demand in terms of people into that situation.
Yeah, and add the Liberal Nationals, of course. Andrew Bragg has come out and said we should be cutting the buffer on the mortgage lending. APRA should be reducing it for first-time buyers. And also we should be using superannuation to allow first-time buyers to be able to buy into the property. I mean, all of that is stoking the demand side, right?
Yeah, was it 50,000? Is that an official policy?
It seems to be. 50,000. Yeah.
Yeah, I'm not sure how much. I wasn't quite sure if that was a trial balloon. I think first I saw it, seemed like it was like we're thinking about doing this. And
I don't know whether there is a formal policy, but Bragg was on the TV this afternoon talking specifically about this idea of putting pressure on APRA to reduce the buffer for first-time buyers, and he did specifically refer then to the superannuation as well as another lever that they were wanting to pull. But all of this is guess what happens? It lifts prices.
Yeah, that's right. Yeah, and it's this whole idea that by increasing people's capacity to pay more for a house does not improve the housing situation. It's if you said that was the case, but it's only for people who are doing new builds or something like that, or things like that, then maybe you've got an argument. Okay, look, we're actually going to build a whole bunch more houses because of this. But going into existing houses is just really just shuffling and
it's more of the same. It's more of the same, right?
Yeah,
and it's interesting. Sorry, go on.
So I'm going to do slightly a product push as well on this, but
go.
So one side. So in terms of using your super for buying your house, I'm dead against. I think there's a good reason to keep your super separate and diversify and all those types of things like that. But the first home buyer super scheme, which is a different thing, is well worth using. So if anyone out there is saving for a first house, or they've got kids saving for a first house or anything like that, then effectively what the First Home Buyer Savings Scheme, FHSS, is doing is it's basically letting you use your tax rate from your super to save, which is different. It's basically giving you a tax dodge to get out. So let's say you've got somebody who wanted to save, an extra $10,000 a year in for saving up for a deposit to buy a house. Say one of your kids or if yourself want to do that, is pre-tax that $10,000, and let's say you're on $100,000 or something, you're paying 33 cents on the dollar. So you go, okay, so I start with 100,000. I start with 10,000 extra that I wanted to save. What I'm actually putting into my bank account is $6,700. But if you stick that into your super, on day one you've got 8,500. So you're getting a 20% plus return on day one just by using your new tax. So so if you want to do that, follow the links to the Walk the World Fund, and we can help you through that. But you can probably do it with your own. A lot of super funds will let you do it. Yep. So you can do it yourself. You don't have to do it through us, but we'll hopefully make it easy for you to do it. But it's well worth doing because it's not about using your super for it. It's about using the tax rate, the beneficial tax rate in your super to do it. It's different to this other scheme, which is basically saying, no, now let's jump into the super that's building up and take that to push house prices higher. Yes. Yeah. Sorry, that was interrupted.
No, that's good. I think that's a very important thing. I'll just come back to you on my own slight ad here. So I made a show called The Next Incoming Tax Grab, Taxing Unrealized Gains, because I don't know whether you saw, Damien, but in the budget there was still an intent from the Labor side to effectively introduce these unrealized gain taxes, particularly on the superannuation, from July next year at an additional 15%. And it's interesting, of course, because that didn't get through the last time around. It got stuck in Parliament. But I am very concerned about this concept of taxing unrealized gains, because I wonder whether this is the thin end of the wedge and whether, in fact, we're going to see similar strategies later for other assets, family savings, or maybe even their home, because this is another leverage opportunity from the government to find a way of getting more money into the tax system, which of course is something they're looking for. So thoughts on this?
Yeah, no, look, I'm not a fan of what they're proposing. I have some sympathy for ones. I actually quite like the idea of, you get of taxing unrealized gains where people are borrowing against the gains, because I do think there's an element of that where it's, say it's there's a lot of tech moguls in the US who basically just don't even draw incomes. They basically just get more shares given to them, and whenever they need more money, they just borrow against the shares that they've been given, and so they just don't pay any tax on any of this, because it's all I had $1 billion, now I've got $2 billion because my share price has been great. So rather than selling some shares and realizing a capital gain, I'll just go and borrow against those shares and use that to go and buy my houses and my mansions and all that type of stuff. I've got some sympathy about saying, okay, in those scenarios and at certain wealth levels, okay, when people are doing that, pretty much to avoid tax, let's now say, well, if you're going to borrow against it, we'll realize some tax as well at the same point. But I do have a problem with people saying, no, on these other assets that are just sitting there and have just gone up, and often, especially these assets that you've given to people for a an advantageous tax scenario that then to turn around and then claim tax and then have the assets fall and have to work out all the different issues around that. Yeah, I'm certainly. I think that's going to create unforeseen circumstances and other flow-on effects that aren't going to be great.
Yeah, well, I certainly think people should be aware of it, and very least, if you are talking to your local Labour candidate, you might want to ask them about what their policy is on this rather important issue. Because although everybody says, "Oh, it's only those with more than 3 million in superannuation," remember that 3 million is not inflation linked. So, if you think over the next 20 years, more and more people are likely to get drawn in. In fact, on some modelling I saw from some of the submissions, they're talking about 500,000 people could be drawn into this. So it is potentially a significant, it's fine because it's only the really rich people are going to get hit today. But next year and 10 years down, it could be much broader spread. And like I say, it could also be spread more broadly into other asset classes too. Why only superannuation? Maybe other share portfolios too. So for me, this is one to watch, and I think it's something which hasn't got much coverage in the mainstream press at the moment. Let's talk about the RBA, because of course they made their announcement today, and they held the cash rate at 4.1, interest paid on exchange settlement at 4. So money held by the banks at the RBA still get paid quite a nice money for that. And they were cautious on the outlook, although underlying inflation is moderating, they said, and they referred back to the statement of monetary policy. It's tracking pretty much in line with what they thought. It's interesting, they said that the measure of financial stress eased a little. Some measures did. Labour market remains tight. Well, we saw that in the data, although the employment numbers were a bit wobbly, because I think the employment numbers are wobbly because of the methodology they use. Uncertainties, of course, was the key thing. Uncertainties about the outlook for the domestic economy, uncertainties regarding the lag in the effects of monetary policy, uncertainty with the outlook abroad, an adverse effect on the global activity is possibly off the tariffs. Inflation could move in either direction, evolving risks from recent global policy developments. I mean, you've got all of them here, right? They still want to sustainably return inflation to target. Policy remains restrictive. It's resolute to sustainably return inflation. I mean, it's a shorter statement than normal, maybe because they didn't know quite what else to say. And it's the new board as well, of course. This is the reconstituted board. But it is interesting that I got the sense of, we don't know.
No, yeah, that's right. But it feels like a dovish hold in terms of they feel like as if they're lining themselves up for a cut in 6 weeks' time, doesn't it?
I think that's right. A lot of people are now saying May, and in fact, the markets are betting now on a May cut. I suppose it depends on a few things. They'll be though after the election, so it won't necessarily help the election campaign.
Yeah, I did note the comment they made about wage pressures have eased a little more than expected, and I feel as if the RBA has even written its own papers on how optimistic they've been about Australian wages, and I do feel as if we're sort of this. We're Australian wages. We're at just over 3, aren't we? We're sort of 3 and a little bit, I think, on wages.
Yeah, that's right.
I mean, 3.5 to me, 3.5% should be a target. Like when you're below 3.5%, you're like saying, well, if our average inflation is meant to be 2.5%, and you've got productivity gains, then wages should be growing 3.5%. Like if they're not growing, if they're going less than that, then I should be thinking about whether I'm cutting rates. And I want to get wages. Yeah.
The critical issue is productivity. Productivity is still very weak, of course, and GDP per capita is still very, very weak. It was 0.1% up last time around, right? Whoopee! But if you go back over the trend, it's considerably down. So the economic fundamentals are the problem here, because effectively we're not creating sufficient growth in the underlying economy to be able to actually pay ourselves more, and that's the dilemma that the RBA, of course, is facing. And they've actually become a little bit more, what shall I say, outspoken with regard to productivity challenges. I haven't heard much debate so far on the election campaigns on productivity-related issues. I don't know whether you have, but I haven't, which I think is quite interesting.
No.
Funny that.
No, but it's too difficult for people to work out what's going on. I think that's probably yeah. It doesn't. I can't get a soundbite that sort of fits into that.
No.
But I think the big picture for me on productivity is the US and a lot of other countries have been trying to work out why productivity is so good. Like the questions, this is happening and that's happening. We want to know why. How do we get these productivity gains and why they're higher than what we thought before? And Australia's got the opposite problem. We're sitting here going, why is productivity so terrible? But that was I haven't got the charts handy, but I think I showed them last time around, the Jared Manac one, which I think sum it up perfectly, which is saying,
shallowing.
Look, you've got a certain amount of capital in Australia. We're not growing it very quickly, and we're throwing all these extra people at Australia. So actually the amount of capital we have per person is actually falling. And so how do you get productivity gains? Well, I give people more stuff. So they, one person can do the work of 1.2 people or whatever it is. And if you're giving everyone a little bit less, and effectively what we're doing is saying, I could, I'll use, there's, say some agricultural type ones, I could look at wages and go, wages are too high. Actually, I'm going to have to go and, get fruit, mechanical fruit picking or whatever it is, we're going to have to get more tractors or automate this thing in some way. Whereas what we're doing instead is we're saying, no, don't worry about that. Let's just bring in a whole bunch of, cheap labor from Pacific Island countries, and you can work them on rock bottom wages. And so, I think that's where a lot of the problem is that for corporates, if it's a choice between saying I've got to do some hard work and come up with a way of running with fewer staff, or I can just bring in a whole bunch of recent university graduates that should be going back to their own country, but because they want to stay in Australia, then they will work for the minimum wage. And so, I think there's we're doing it to ourselves on that productivity front. And then the other problem, obviously, is that most of our growth is all coming from the NDIS in terms of wages. Sorry, not in terms of wages, in terms of employment. And so, actual private sector employment is terrible. And so, I guess that's the other thing back and saying, well, are we worried about a wage price index, and not enough people and rising when the only one out there hiring is the government anyway? I think there's I would much prefer to see politicians actually complaining about saying we want to get that we have a genuine role rather than targeting GDP, which is some sort of nebulous figure that nobody really knows what it is. Is actually saying no, Martin, I want to get you a wage rise. I want to, I think it's success. I think it's a greater thing if we're all getting 3.5% or 4% wage rises. I'm not looking upon that as a terrible thing. We need to bring more people in to push our wage growth down.
No. Well, it's clear that in earlier times, low wages was a policy. It was effectively a feature, not a bug of the system. And that's partly the high migration. It's partly businesses pushing for cheaper wages. And to be fair to the most recent government, they have moved the dial up a little bit. But if you look carefully where wages growth has actually been strongest, it's not necessarily spread that uniformly. And I do want to highlight again, this market versus non-market jobs story is very important to understand. And a lot of the jobs are in the private sector, but they're completely funded by the public sector, like in DIS. So it's not really a very fair to say, well, it's those in the private sector as well that are actually, they're being funded by the government. So,
Exactly. Yes.
I
found that chart. I just brought that up with it's a little bit of an old chart. It's 3 or 4 years old now.
Yes.
It's the RBA showing. So what this line is showing is the black line is what the wages actually were. And then each of those little lines coming up is what the RBA was forecasting. So in 2011, they were forecasting wage growth was going to go from sort of 3.5% up to 4.5%, and then it fell. And then and every single time, it's just like they're just way too optimistic about what wage growth is going to do relative to what it actually did over the time frame.
Yeah, and so, this is a consistent pattern, right? This isn't just a one-off thing. This is again and again and again and again and again and again. Yeah. It's happened, right?
But that's their own chart. Like they did that chart. Like this isn't somebody else going, hey, what a bunch of fools these guys are. They actually owned up to it and said, "Hey, we've been really bad at forecasting wages. Look, why are we always wrong?" And then they proceeded to keep on being wrong for the next 5 years. Like I sort of, that's the I'm quite glad they actually had the sort of owned up to it, and you want to admit your mistakes and know where you are, but then after you've admitted your mistake, to keep on going and making the same mistake, that's the problem.
Root cause analysis suggests that you should look at why you made the mistake and do something different. Yeah. Otherwise you'll get the same outcome, and that's partly I think a lot of the issues. The data is quite clearly pointing to a number of significant structural issues that we have, not just in Australia, but in Australia particularly at the moment. And yet we don't see a huge amount of reaction to try and change trajectory. And I guess that takes us quite nicely to one where there has been a change of trajectory, and that's the recent gas reservation discussion, right? So the Conservative side of politics have come out and said, we're going to reserve more gas. Well, actually, no, we're going to actually invest in more gas to be able to increase supply and implicitly create more of a reservation. It's a bit fuzzy, actually.
It is. It's at first blush, it looks great in terms of saying gas reservation. That's fantastic. I'm worried about the fine print. Partly because the gas industry has been so successful in Australia at lobbying. They've just done such a great job of getting everything they could ever want. That I'm naturally skeptical. But it does. The idea of gas reservation is great. Like, that is what Australia needs. Yeah. Or what East Coast Australia needs. West Coast Australia's got it. East Coast Australia needs gas reservation, because the problem we've got is the world is a really big place, and every time we produce more gas, there's somebody in China or Japan or Europe or somewhere like that who wants to buy it. And so if the guys who are in Australia have got a choice between selling it to somebody else overseas for $15 a gigajoule or selling it to somebody in Australia for $5, guess what? They're taking the 15. And so, I think there is a reservation policy, that the same one that exists in pretty much every other country that's a major energy exporter, would be fantastic in Australia. Yes, I like the fact they're doing it. I'm hoping that Labor decides, hey, why don't we take that and one up it and get a bit of a bidding war about it. But I'm more worried that Labor will ignore it, and if the Liberal one gets up, there'll be some sort of fine print that none of us noticed that sort of says that, well, it only applied to certain ones, and it's anyway. But at least it's conversations. At least it's in
the discussion. It's quite fascinating to me. The three quick observations. Firstly, people are beginning to question whether you should be actually importing the gas that's been exported at international prices, and is that really going to solve it? We'll bring it down to Victoria. And the second is, of course, that the pipelines that exist aren't at full capacity, so you could be pumping gas south through the cycle rather than just when you need it. And I know there's some storage issues, but it's much easier if you actually think about, I've got a longer period of time to pump it through. And the third is that it's clear that some of our gas is being sold offshore to third countries, who then sell it on and are making a profit over the top of it. So, we are just, it's bust. And as a result of that, and because of the marginal cost of electricity being linked to the price of LNG, what it means is that energy is very expensive in Australia, which then directly has a knock-on effect on the manufacturing sector, which is why I wanted to get this conversation too. Because for me, the real fundamental problem we have in Australia is that, we dig stuff up and sell it offshore, the holes, and we build houses, the homes. But what about our manufacturing? What about the stuff that we actually should be manufacturing? And if you think about the Trump context and the tariff context and what's going on there, isn't this an opportunity to think about actually building and developing and, making stuff in Australia? But without the energy at the right point, it's going to be impossible.
No, that's right. And the issue we've got with a lot of the remaining manufacturing is a lot of the remaining manufacturing is the stuff that was relatively energy dependent, because Australia for a long time we've got so much energy, and it's been relatively cheap, and they're some of the ones that have managed to survive have been the ones that have been relying effectively on these low energy costs, and now we're getting rid of those low energy costs, and so I have. Look, I've got grave concerns about the Australian manufacturing sector, and I do think that we benefited from Biden in terms of he had an industrial policy which was, look, we're way too dependent upon China. We actually need to be dependent upon ourselves and our close allies. And so some of his policy actually was benefiting Australian companies because we were sort of we actually fell under that. So we're getting. We're effectively being subsidised by their industrial policy, and when we haven't got our own, that's actually saying, well, maybe it would be good for Australians to keep some of these things, and the whole idea of it was Angus Taylor who got us our strategic oil reserve, bought part of the US one. Now the US strategic oil reserve sits basically bang in the middle of continental US. And it's like, how strategic is it for Australia to be literally on the other side of the planet and not even next to an ocean where you can sail it across? You got to get it out of the middle of America onto a boat and then get it to Australia. It doesn't sound very strategic. And I think there's I do think there's a certain amount of I guess it's all about it's more about the message and not about the actual, what are we doing this for? If you do genuinely want a strategic oil reserve, then it should be in Australia. and if you do genuinely want to have fallbacks for some of these things, is it relying on, and particularly I think Trump's very much brought it to the fore, is it relying on the US to be able to do all this stuff for us? It's been great, but is that a plan for the next 10 years? Is that something we know we can rely on? Or maybe somebody says the wrong thing at the wrong time, and next thing Australia's the one that's on the other end of Trump's thing, and he's not selling us whatever it is that we need. And so I do think there's we do need to be thinking about the risks, and particularly with China doing live firing off the shore of Australia. They're obviously sending a message to Australia. It's a new world, and maybe the US is not as close a friend as you thought they were.
Well, it is interesting. Certainly in Europe, the question now is how reliable a friend is the US. Can you rely on them, from a defense perspective, but also more broadly from a democratic support perspective? And in some countries, those debates have actually been quite rancid. People are really quite concerned. Even in the UK, who have always had the quote special relationship with the US, there are people now saying, well, can we rely on it? Should we rely on it? And if not, what does that mean? And I think some of these shifting sands in terms of the global world order, and the assumption, of course, and I made a show the other day called Pax Americana, is perhaps over. Maybe you can't rely on the sort of worldview that you have, where the US is the backstop cornerstone of democracy and economic sensibleness. Maybe that's never been true, but it's maybe even less true now, which begs a whole bunch of interesting questions about the future of economies and BRICS and China and all sorts of things.
And I do want to say, though, for all Donald Trump's faults, he often has some grains of truth at the heart of what he's trying to do or he certainly managed to identify grievances. And from my perspective, I fall very much into what I'd call the Michael Pettis view of the world, which is countries can keep their currencies too low, and effectively they keep the currencies too low or their wages too low, in the case of, say, Germany, and currencies too low in the case of, say, China. And what they do then is they effectively employ more people because they've got their wages low and their currency low, and so their people aren't importing goods because the currency is too low, but they can export more. And that is it's often thought of this problem about US imports too much because they're not they're not frugal enough, and Americans live in big houses and whatever it is. There's all these things about that. and I think Australia suffers from that same part about having an open economy and a floating dollar, is that other current countries do take advantage of that. Now, do I think global tariffs of 20% is the right solution? No, I don't. But there is a point about that whole, should we allow countries to, either through their own trade policy or through manipulating the currency, keep currencies at levels that are too low. And so, I do think there's a part of this which is, well, it would be good to rebalance trade. So ideally, in an ideal world, is the rise of China is, and why China owns so many US treasuries is effectively because they're manipulating their currency. What they should be doing is, what they're effectively doing is saying, okay, well, I've just sold $100 worth of goods to America. If I took that whole $100 back and converted it back to Chinese yuan, then the Chinese yuan rises because I'm selling US dollars, and now my citizens get richer. I can't export as much to the US because we're more expensive. And actually, my citizens start to buy US stuff because now their wages are higher and they start to afford, and the whole thing rebalances. But China's managed to sort of keep out of that by keeping their currency down and holding all that. They sell $100 and we'll only bring 50 of it back. We'll leave the other 50 sitting in US treasuries. And so a similar case for Germany, but Germany was done more through wages, keeping the wages low for particularly manufacturing, which is why they're a real export powerhouse, not because of sort of some magical German thriftiness or anything, but because of industrial policies. And so, and also that they're part of the euro, that's sort of got all these other issues. And so, there are genuine trade issues that we think about in terms of how countries and currencies and everything like that react. But it is worth reminding that, look, he's been successful at identifying the problem, and it's just whether you're applying the right solution to it. And I don't think that's the case.
No, very, very, very good point. Well, as we sort of come up towards the end of the show, there were 3 slides I just wanted to spend just a little bit of time with you on. And the first one is this one. This is the Nikkei. And what I find fascinating here, of course, is that the Nikkei is basically reacting to higher interest rates in Japan, and the expectation of inflation is we need a bit more of it, and things like that. So there's a really fascinating story here about what Japan is up to. And remember, of course, that they have the GDP to debt ratio at 300 and something. I think it is. It's the highest, pretty much the highest around the place. The government owns a lot of the assets, investment assets, over a long period of time. So what's your take on what's going on in Japan?
Yeah, so Japan's interesting. I think the net number, though, I must admit, I can't remember. I don't know if I've checked in the last year or two.
I think it is.
No, that's the gross number. So you basically the government's got the 330, but if you take out that the central bank owns 200 and something percent of it, I think you get back to in the 70s or 80% or something like that. It's actually, when you net it off, it actually looks nowhere near as dangerous. So it's basically that you've taken it. It's like me lending money to my wife. All of a sudden, she owes me $100,000, and I've got this $100,000 asset. She's got this $100,000 debt, and it's like, well, it's both our money. Tomorrow we could just decide that I no longer have the asset and she no longer has a debt, and from an external point of view, we haven't changed.
Just net it off. Yep.
Yeah. So I do think there's a certain element of that in Japan. As you said, Japan's been buying. I think they're up to 10% of ETFs. Yep. Actually, I must admit, I haven't looked again at this one. Probably it might have been 2 years since I've looked. But I know at one stage it was that 10% of all ETFs was owned by the Japanese government. The Japanese central bank. So they do have to get out of that low interest rate environment problem. So the interesting thing for Japan has been, every time they have tried to get out over the last 20-something years, they've managed to cause a recession and drive it all back down again.
Yes.
And so interest rates are going up there. And it's one of the few countries where things are actually starting to look a little bit better in terms of implied rates. I've actually got a chart up that's, I think, it's worth showing as well. That's got the Fed. So this is showing, in blue is showing what the implied rates were at December. So, for example, in the US, it's basically saying, okay, they're expecting rates to fall at December, but now they're actually expecting rates to stay higher for a bit longer, but then fall more. once the tariffs score kick in and economic growth slows down. Europe, they're expecting some massive falls, but actually they're thinking things are actually looking like they're a little bit better than what we thought. Bank of England's looking worse, and Japan's got the only one where where the lines are going the opposite direction. That people are expecting rates to rise, and they're actually expecting rates to rise more now than what we thought at the start of the year. So certainly things looking better in terms of that. Inflation's still not particularly high. They've still got the question is whether they're actually the working population has reduced far enough that now they'll actually start getting some more wage growth through. And there was certainly within Japan, there was I guess it's more of a social, call it quite a social contract, but there's certainly companies felt as if they needed to keep prices low, and sort of like an embarrassing thing to be putting prices up, and something you might need to apologize for. And so, has that changed? I don't know. But I guess it's I guess what I'm thinking in terms of Japan is it might not be the type of inflation you want. If it's inflation driven by actually now our working population, we've got this aging population where all these people are retired, and we've got such a smaller number of people supporting that we actually can't do as much of the stuff. And so we've got to give wage rises to these people. Is that the type of growth you want? I don't know. Maybe it's an intergenerational switch, but there's sort of like I've got a few questions around that. But the bigger question is, look, are they genuinely out of this, or is this just another time where we're going to see, and often they end up in some sort of financial crisis afterwards. It feels like every time the rates have just started rising, they've ended up somewhere, crisis around the world. So I've got positive overall thoughts. We've actually got a fair bit of Japanese stocks in our portfolio because we think they're relatively cheap and much better quality than they used to be. But interest rates are still really, really low, and I'd love to see them normalize. But I just I feel as if it seems early to me for interest rates to be normalizing still, just because the inflation really isn't high enough that I'm in any way concerned about the Japanese inflation.
It's worth highlighting the demographic problem they've still got, which is they've got a very low birth rate, as has Korea and a lot of the other Asian countries. Well, in fact, Australia's birth rate is still, is declining. It is in the UK too. So effectively, there is a question about the population into the future, because there are a significant proportion of elderly people in Japan who obviously won't be around in 10, 15, 20 years' time. So there's a bunch of questions.
But I think the issue they've got at the moment is that it's every year you've got more old people who have retired and fewer workers.
Yes.
Yeah. So so you've got fewer and fewer people supporting a larger and larger number of people, and no immigration to speak of. Like immigration into Japan is very difficult, and you don't get the same legal rights. And definitely a vision of the future. Wow. And as well, that's same is true of China. And China's basically Japan rolled back 20 years, but accelerated. Like they've got the same things happening, but just happening at a way faster pace than what we saw in Japan.
The second chart I wanted to switch to was this one, which is the Aussie dollar against the US dollar, right? So we're sitting at 62.53 cents at the moment, and we've come way down from where we were previously. In fact, if you go back and look over a longer period of time, of course, you can see that back in 2014 we were above, a dollar. Yep. Now we're at 62, and it doesn't look as though we're going to go anywhere the other way anytime soon. So two questions. What does that do in terms of your thinking about investment strategies? And does it matter if the Aussie dollar is down in the low 60s or below?
Yes. So on the investment strategy point of view, I just want to highlight that the currency works really well for Aussie investors. as somebody, let's say, I'll flip it around first. So the way a foreign investor thinks of Australia is, say you're a US investor or a UK investor or European, you'd look at Australia as being a sort of turbocharged way to play world growth. So when world growth is really strong, the Australian economy goes well because we're this exporter with all these commodities and commodity prices go up. And so the market's going to go well, but actually the currency is going to go well as well. The currency is going to rise in those scenarios. And so you get double the benefit. So the stock market might go up 10%, the currency might go up 5%, all of a sudden I've got a 15% return. And so that's great. But the same is true in reverse. When the world growth is bad, the Aussie dollar falls and the share market falls. And so, I turn a 10% into a 15 or a 20% loss at that point. So that's great. But if you're an Australian sitting inside looking out, it actually ends up being the opposite in terms of when things are booming globally. We can invest in international stocks and the Aussie dollar is actually going to bring those returns back up a little bit. But when we run into problems, we saw what we've seen in recent times now is the Aussie dollar, the share markets might fall 5%, but the Aussie dollar falls too. And so you're only down 3% in terms of your international investments. And so the volatility on international investments, versus Australian investments is actually quite, for the last 10, 15 years has been significantly lower. And so if you can get a better return with a lower risk, that sounds like a good deal. And that's where we've been spending a lot of time investing in international stocks. One of the currencies over the midterm makes a massive difference. Over the short term makes a very small difference, but over the midterm, I actually think this is one of the biggest drivers in terms of economic growth between, the differences between countries is that sort of longer term where the currency has been. So, and it's not just manufacturing. I think it's probably, and for a country like Australia, it's probably some of the services is probably more important. So, you're a global company and you've got stuff everywhere and you're thinking about sticking a new lawyer or a new accountant or something in your Asia Pacific division. If the Aussie dollar is at a dollar and Australian employees are really expensive, well, I'll stick them in Singapore or Tokyo or somewhere like that. When the Aussie dollar is back down near 60 or into the 50s, Australians are well educated, and if I can find somebody that I can hire and use the Australian dollar to pay them sort of less on a global basis, then they absolutely will. And that's one of those mechanisms that helps even out growth between countries and does sort of determine some of these longer term things. But it's not something that flips around. It's not like the Aussie dollar falls overnight by 5% and all of a sudden everyone's hiring staff in Australia or building factories and everything like that. It takes a while. It takes a considerable, it's that longer term average that really makes that difference. And so, our expectations are that at the moment, it looks like Australia is probably not going to play the tariff game. And so we're probably going to see other people dumping their prices on Australia, and so dumping their cheap goods on Australia. So we're probably looking at lower inflation in Australia. We are tied very much to China, that we're expecting to bear a lot of the brunt of the Trump tariff war, and so that's sort of one more negative. And so interest rates in Australia are probably going to be lower than what we're going to see elsewhere. And then that sort of then leads to a weaker Aussie dollar. And so typically as well, when we're going through global downturns, as I spoke about Australia being a leveraged play on sort of world growth, is that Australia typically does worse in economic downturns and better in economic upturns than the rest of the world. So sort of a high beta play, so to speak, on the world economy. So, we sort of look upon this as a chance to, at the moment, still getting keeping with your international stocks and sort of avoiding Aussie stocks. At some point, though, once we start thinking that the global cycle is changing, then you probably want to start hedging some of that US dollar exposure or some of your international stocks and investing more in the Aussie stocks. But I think we're some time away from that at the moment. We're still running at sort of 2-to-1 ratios of international versus Australia.
Yeah, sorry, the dogs have just gone off.
Right.
Apologies.
But the actual dogs, not the
no, the real dogs,
not the metaphorical ones.
No, exactly right. Okay, last slide. I wanted to just throw up Bitcoin. So Bitcoin's now at 84. We got up to 108. And interestingly, there's a huge diversion of opinion as to, what's going to happen with Bitcoin. Now, I know we've always said Bitcoin probably shouldn't be your major holding, but have you anything changed in your views of Bitcoin as to what's happened recently? Trump and the idea of a strategic reserve in Bitcoin, et cetera, et cetera?
Yeah, well, I think, look, I think when the Supreme Court made it pretty clear before Trump got in that anything that's sort of vaguely to do with being a president, he couldn't be prosecuted for. I think it opens a fair few avenues for, Trump to sell things like his own coins and other things, and have family members involved in doing things. Given that there is effectively no regulation in this area, or certainly there's, within the manipulation of prices within that, there's no regulation. I would be a little extra concerned about Bitcoin in the era of Trump. Just that, are you inside and do you know what the latest announcement is going to be? If so, then maybe you can get out and trade this stuff. But there isn't insider trading laws around Bitcoin that I'm aware of, and you have a president who I believe would be happy to manipulate the price for his own gain, and is covered for not needing to for that not being a criminal offence. So yeah, I think you might have reasons to buy or not buy, but I think I'm very concerned about economic growth and economic uncertainty around policies from the US, and whatever I think about that, I can times it by 10 for how much volatility I'd expect around crypto assets.
Yeah, well, I think we're going to see more volatility. I should explain the dogs go off now when the bin collection is going on, and it's now different from what it normally is. So that's why they're suddenly getting very excited.
It's not the mention of crypto.
No, it wasn't the mention of crypto. It could have been maybe something else. No, it's interesting. I'm fascinated because I've had a few people say to me recently, well, maybe, everything else is falling apart. Maybe crypto is the way to go. And I'm saying, well, hang on a moment, be careful. There's stuff going on in the crypto world, not least because of the big players now coming in, not least because, as you say, Trump and what he's doing. It's very hard to really know what you're getting into. And so I wouldn't put all your eggs in the crypto basket.
Yeah, that's a good point. I was going to bring up let me just see if I can bring it up quickly. There's a chart I wanted to show. Sorry. Let's see if I can actually type now, about the growth, about the dividends you get from stock markets, and dividends and buybacks. So let me just bring it up for the US. I'll bring this up. So this is the S&P 500, the level of dividends that you get from, if you had bought all the stocks in the index. Now, there's some ups and downs within this, but even some of these worst cases, you over that 2006 to 2008, you're paying $70 in dividends. It tipped its way up to 80 for over a year or two, but then had this big tumble, but it was still stayed above sort of 60. You sort of if you went back to sort of 2 years before, your dividends were down maybe 10%, maybe 5 or 6%. That's one of the biggest falls we can see in that whole series. The amount you get through in terms of dividends on stocks is a pretty consistent series over time. And so when you buy stocks, if you're looking at a stock and saying, okay, I'm buying it and I'm getting a dividend yield of whatever I'm getting, if the share price falls, you're probably still going to be getting the actual dividend and pretty close to that dividend. If you've got a diversified portfolio across a lot of stocks, which this one is. If you buy Bitcoin and things go wrong, you don't get anything extra. There's nothing behind that. And a similar story for gold. Gold does not give you a yield. If you're buying gold and the price goes down, well, you're not sort of still getting rewarded for it. Whereas there is an element of stock buying where it's across a large enough portfolio, and I'll get into a little bit more detail into that in just 1 second, but it's that, okay, if I'm getting a 2% yield and that yield is growing over time at 5 to 10% per annum, then yeah, it's a low yield, but it's growing. And so as long as I know it's growing, then, and particularly you'd say in your superannuation fund or something like that, where you weren't planning on spending it, if you're not retiring imminently anyway, you've got that idea that what I'm really buying is this ongoing stream of payments that's just going to keep getting bigger and bigger over time. So that's one part of it. Within individual stocks, this can go terribly wrong if you try and take this view on in an individual stock, particularly say if you're looking at resource stocks and saying, oh, look, I've got this great yield on XYZ resource stock. That resources stocks don't pay out consistent dividends. But that same line for a resource stock goes to zero for long periods of time and then suddenly shoots up to massive levels and then goes back down to zero when things get tough. Like individual stocks, yeah, this can be all over the place, but broadly speaking, as a diversified market, it's a pretty stable stream, even in some of the worst downturns we've ever seen. To say that from 2006 to 2010 that you've lost 10% of your dividends in one of the worst downturns we've ever seen, okay, that's never good to lose, but that's not such a bad outcome, over that period of time. Sorry, I've lost your sound there, Martin.
Sorry, I muted myself. The dog was making noise again. Yeah, so very important perspective there, I think, Damien, because, if you take a longer term view of what's going on, you can ride through some of the ups and downs, but don't throw the baby out with the bathwater is what I always say. And as I said earlier on, there are points in your life when making decisions in a relatively short period of time, you may want to change your strategy. But if you are investing for the future, then that chart really is a very important chart to bear in mind, because if you have a portfolio that's actually going to continue to pay dividends and you're holding the shares, so in fact the share price is not that relevant, right? It's only relevant if you're going to buy or if you're going to sell. If you hold and get dividends, then that's a cornerstone of the investment strategy, which over time tends to work pretty well.
Yeah, that's right. And the other thing that falls behind this, I need to write this up in a way that's more understandable for people, but this dividend stream, it's actually growing faster than it used to. And the reason why is because we've got more buybacks now. Buybacks actually used to be illegal. And so what you're effectively doing with buybacks is you're increasing the per share growth rate, so to speak. It's financial engineering in the end, yeah. But it's basically saying that actually I can expect, because companies are doing such big buybacks, I can actually expect the dividends to grow faster than what they've done in the past. And so getting a 5 to 10% growth rate from dividends, I don't see as a major, it's not a majorly bad assumption. It's not like saying, oh, how can they possibly do that? Over time, as you go, well, they're getting inflation, they're getting some productivity growth, they're getting some profit growth on top of that. Often about 6% per annum is about the sort of figure that sort of comes back through, and then they're getting this per share gain that's coming through because they're doing the buybacks as well that can sort of lift that to some high numbers.
Yeah, very good point. Well, I think that's a good point on which to end. Just to say, of course, that as we often mention, the What the World Funds and the Nucleus Wealth platform is a very open platform, a transparent platform for people to be able to make quite significant range of investment choices, manage it yourself, get them to manage it. You can dip in and dip out, and also have different segments. So very transparent. And I think in the current environment, such transparency and accessibility is pretty important. So if you haven't checked out the investment platform, now's the time.
Thanks. Excellent. So
I think we're done.
On another month. Is there anything else?
Yeah, no,
excellent.
I was going to say, I think we're up for in a month's time. Thank you very much for your time tonight, Damien. Very interesting conversation, interesting time in the markets. And final question, which Cookie asked earlier on. Next time you talk, do you think the S&P will be higher or lower than where it currently is?
I think it'll probably be lower. It's a bad thing to say. As a fund manager, I need to tell everyone, hey, jump in and give me your money while you still can. I do think it'll be lower. the question, but there's a reasonable amount of uncertainty. I do think that that key thing we're really watching now is what's going on at the coalface. What are we seeing in terms of companies? Are we seeing that Joe Sixpack in America, is he actually going to stop spending or not? That's the real key. And I think that's going to unfold over the next 3 or 4 months. But the worse that looks, stock markets will be down. But if it holds up, then that's where you can see some rises, and in a couple of months' time, we'll start. I think they'll actually have some movement on things like tax cuts and things like that starting to push its way through the US system, which will be looked upon as a positive as well.
And my final takeout for tonight is that the index doesn't tell you everything. It's important to go down and look at the individual portfolios, individual stocks, individual sectors, because actually, if you look carefully, some sectors are doing quite a lot better than others and will continue to do so. So again, a bit of sophistication rather than just following the top line index is probably sensible.
Yeah, absolutely. And actually, one other thing I would say though, if you asked me that same question any time in the last 3 or 4 years, I've probably got less certainty this month than almost any other month. Yeah. Tomorrow we've got a very big announcement coming from Trump's, and here's the unfortunate thing about that will be the whole world will have his eyes on him, and he'll get his hit of whatever he needs in terms of that, and then he's going to have to do something bigger next month to try and top it. King
Trump will have spoken. Damien, thank you very much. I appreciate your time as always, and I'll look forward to catching with you next month. I'm going to take you offline now, and I'm going to close the show. Well, I hope you found that interesting and informative. Don't panic. The markets are the markets, but if you understand the markets, you can still navigate through, and it's not necessarily all gloom and doom. Anyway, just to say that next month, Damien's back. Next week, I'll be on, and I'll be talking about my latest modelling I've just updated for the last month. So we'll be looking at some of the detailed data there and looking at some of those broader things. Whoops. Get rid of that. I pushed the wrong button. Get rid of that. Sorry. Trying to do 3 things at once. So thank you very much for spending some time with us this evening. The dogs, well, I've got one dog. The other dogs are around my leg, but they've of course got up and barked quite a lot today, so I'm sorry for the doggy noises, but it's part of the package here. Anyway, I want to say thank you very much for spending some time with us this evening. I hope that everybody goes well through the election campaign and through Trumponomics, whatever that's going to be. And I'll look forward to seeing you on the next live show. And of course, check out the recorded shows that come out every day of the week. This is Martin North from Digital Finance Analytics signing off. We'll see you next time. Take care.